One, we had the return of inflation, spikes in gas prices, a gummed up supply chain, and the great resignation, which saw millions of Americans bid adieu to their old jobs. What will 2022 bring to the U.S. and global economy? For answers, let me bring in Ruchir Sharma, a global investor and a contributing editor at the FT. Ruchir, you have a few really fascinating predictions in the Financial Times. So let me ask you about some of them. The first one you talk about is the baby bust. Explain.
Well, Fareed, one of the defining features of this pandemic has been that instead of upending the world, what the pandemic did was to accelerate many trends that were already underway before 2020. And one of those was the demographic shift that we are seeing, which is that the world's working age population and even the population growth rates had been slowing down for many years before the pandemic. You would have expected that during the pandemic, with people staying indoors, that they'd be having more babies. Instead, the evidence that's come in is that the demographic decline or the decline in the world's birth rate accelerated during the pandemic. And that, I think, has major implications for global growth going forward, among other things.
One of the points you make is that Chinese growth has slowed down. We've all seen this, but surprisingly, it doesn't seem to matter as much as people used to think it would.
Yeah, just see what's happened over the past couple of years, especially in 2021, that you had a major slowdown in China's economic growth rate, and yet so many economies around the world accelerated. And I think that this is a big change which is taking place as China turns more inward and also as China's growth rate slows down. So I think that we are at peak China, which is that the contribution of China to the global economy is going to keep declining after the peak it reached in 2019, when China alone was contributing to nearly 40% of the world's economic growth. I think that number has come down to about 25% and will keep going down in the years ahead because China faces so many structural challenges, from the decline in its population to the incredible amount of debt that it has piled up, which is undermining productivity in China now.
And that issue is the one that you really focus on, which is debt. I mean, when you look at the transformation of the picture for the world's major economies in terms of the massive increase in debt over the last 10 years, but really the last year or two, describe what that looks like.
Today there are more than 25 countries in the world which have a debt to GDP ratio of more than 300%. To put this in perspective, in the mid-1990s, there were no countries in the world which had a debt as a share of their economy that was as large as 300%. So a massive amount of debt has been taken on. During the pandemic in particular, we saw some very sharp increases in debt levels led by governments around the world that were taken. Now, you can argue that during crises, it's fine to take on more debt to ride through the troubled times. The problem is that even during the good times now, we keep on taking more debt. And this has some serious implications, not necessarily in terms of a crisis, but something more insidious, that by taking on so much debt, we're keeping alive a lot of inefficient companies, a lot of zombie companies, as I call them, and that is undermining productivity and is also one of the trends that I speak about.
When you look at rising asset prices, low interest rates, which fuel rising asset prices like stock prices, one has to ask, I mean, American stocks are at extraordinary highs, all-time highs. It does appear to be something like a bubble. Is this a bubble?
I think there are pockets of what I call bubblets in the market. So electrical vehicles, I think in clean energy, I think there are so many technology stocks out there with no earnings. I think even cryptocurrencies, which is a good idea, that's gone too far. I think that there are these bubblets out there and they have started to deflate. on average, the prices of many of these bubblets are already down 35 to 40% from their peak. And my guess is that they have much further to go. I'm particularly concerned about a lot of small and retail investors who have rushed in and bought these assets in the last 18 months or so. At the same time, the insiders, the big CEOs at companies are selling the stock of these very companies. So that's a mismatch that we have to look out for and a warning sign, I think, for the markets.
Ruchir Sharma, always a pleasure to have you on.
Thanks, Fareed.